All right, so the coronavirus pandemic is pushing the global economy into its dark days, cutting world outputs down by a number of measures, and the crisis could get worse. We have chief economist, we wish we had her, but the chief economist of the International Monetary Fund, Chika, expects the global economy to shrink by 3% this year before rebounding in 2021 with 5.8% growth. Gita acknowledges, though, that prospects for a rebound next year are clouded by uncertainty.
So now, under the assumption that the pandemic and required containment peaks in the second quarter in most countries in the world and then recedes in the second half of this year, we are projecting global growth in 2020 to fall to minus 3%. Now, this is a downgrade of 6.3 percentage points from January 2020. A major revision over a very short period of time. This makes the Great Lockdown the worst recession since the Great Depression and far worse than the global financial crisis. Assuming the pandemic fades in the second half of 2020 and that policy actions taken around the world are effective in preventing widespread firm bankruptcies, extended job losses, and system-wide financial strains, we project global growth in 2021 to rebound to 5.8%. Now, this recovery in 2021 is only partial, as the level of economic activity is projected to remain below the level we had projected for 2021 before the virus hit. The cumulative loss to global GDP over 2020 and 2021 from the pandemic crisis could be around $9 trillion. Greater than the economies of Japan and Germany combined. So for the first time since the Great Depression, both advanced economies and emerging and developing economies are in recession. For 2020, growth in advanced economies is projected at minus 6%. Emerging market and developing economies, which typically have normal growth levels well above advanced economies, are also projected to have negative growth of minus 1% and minus 2.2% if you exclude China.
All right, without further ado, we're joined by partner and chief economist, PwC Nigeria, Mr. Andrew Nevin, who'll be looking at the IMF projections for developed economies and what could actually happen to these economies in coming years from his point of view. Also joined by the CEO of Alpha African Advisory, Ms. Sanyade Okoli, who will be focusing on South Africa, businesses there, and preferred solutions and how the country could come out of the woods. Also feeling the pulse of global stock markets and major commodities like oil, gold, and currencies, and so on. Maybe even go into cryptocurrencies. Research analyst FXTM, Mr. Lukman Otunuga, is also on standby. And of course, right here in our studio, our very own Arise business analyst, Mr. Chika Mbonu, in Nigeria, looking at Nigeria and factors that could drive the economy possibly out of recession. We're looking at that as well. Chika, you're welcome. You're welcome, everyone. All right. Andrew, let me start with you. I want to read a quote from the IMF projection. There is extreme uncertainty around the global growth forecast. The economic fallout depends on factors that interact in ways that are hard to predict, including the pathway of the pandemic, the intensity and efficacy of containment efforts, the extent of supply disruptions, the repercussions of the dramatic tightening in global financial market conditions, and so on and so forth. So based on the above excerpt, seeing as they're saying that there's a lot of uncertainty around the projections, do you think the IMF projections could get slightly better or slightly worse or much better or much worse?
Well, I think they could get much better or much worse. If we look at what economists said in this crisis, the unfolding crisis, in mid-February, you had people that were taking global growth from 4% to 2%, 4% maybe to 1%. As late as mid-March in South Africa, one of the top economists suggested that the economy, worst case, would be a shrinkage of 0.5%. So I think the economics profession has really been behind the curve on this. It's only now people are recognizing this is the greatest economic health and economic calamity, certainly in our lifetime. So when we say that global economy is projected to shrink to 3%, that's enormous. But what we've seen with the pandemic and the health effects is it's very hard to predict. So, for example, we'll talk a bit more about South Africa. the rest of the show. But right now, so the president of South Africa is saying that the pandemic will peak there in September. So if you think about one thing that everyone has learned from this crisis, is that one person's spending is another person's income. So when people are locked down and no longer spending, other people's income collapses. Now, if you have a lockdown in some form in South Africa to September, what are the expectations for growth? And of course, we're not immune from that there. We did 2 weeks, we extended 2 weeks more here in Nigeria. This goes on longer and longer, given the informal economy, the daily wages. Very difficult to predict. So it could be better. It could also be much worse than minus 3%.
Thank you for that, Andrew. Ms. Sanyade Okoli, let me come to you now. Andrew just mentioned South Africa a moment ago. You've been on the show several times with us in the past talking about South Africa, about a myriad of issues, and this was before COVID-19. So, Ms. Sanyade, when you add COVID-19 now and the projection for South Africa to contract by 5.8%, is this the perfect storm for South Africa right now?
In Q4 of 2019, so they're already on a downward slope. So this pandemic has really hit them at a very wrong time.
Okay, and let me come to you, Lukman, over in London. Lukman Otunuga, research analyst with FXTM. Lukman, we spoke about 60 days ago about the markets. Let's start with the equity markets, which now seems like almost a year ago. I wanted to get your take for the equity markets, how they've performed since the last time we spoke, looking at the impact of COVID-19.
Thank you for having me here today. We can see that global equity markets have been treated without mercy by the coronavirus outbreak. And this is exactly what we're saying. Despite the unprecedented measures enforced by central banks and handsome fiscal packages from governments, there's still a major element of uncertainty in the markets. And this has been reflected in US stocks, Asian stocks, and European stocks. I think it's the psychological aspect of the coronavirus that is going to continue enforcing that stock markets should trade lower. At the same time, we have earnings season in the United States, and it's already given most of the investors a better appetite of what to expect in the second quarter of 2020. So I believe as negative data continues to feed in and corporate earnings heavily disappoint, and especially the lockdowns continue to extend, this could be nothing but bad news for equity markets in 2020.
Wow, gloomy outlook. Thank you for that, Lukman. Chika, over to you. Look, also same scenario. Nigeria, the projection is a contraction of 3.4%. The World Bank, I know we're talking about the IMF, but the World Bank has also said that sub-Saharan Africa could also contract in 2020. When you look at our fiscal buffers and where oil prices are, how bad do you think this could get for Nigeria?
I think the first thing is we need to posit this. And the COVID-19 crisis has masked our precarious economic situation. Do recall that before now, we were coming out from a recession in 2015, 2016, and our GDP was growing at a very snail speed. Yes. And indeed, at the onset of this COVID-19 crisis, the World Bank, IMF, moved down our growth from 2.5 to 2.0. So we're already operating on a negative per capita growth profile. Now, this COVID has made things worse for us. So in all parameters, it's very bad for us. The fiscal buffers are not there to, provide a safety net for us. That has disappeared. All the issues that we have been pleading with the government to implement, to position the economy on the right path, have not been done. And our reserves have been, falling like, pinballs. So, yes, it's going to get bad for us because of the other issues that we know happen in the economy now. Unlike other economies, there's no fiscal buffer to fall back on to support the economy and tidying up through this difficult period.
Thank you for that, Chika. Andrew, let me come back to you. I want to quote Kristina Georgieva, who the IMF managing director. She said she's called this, quote, a crisis like no other, and said we're still faced with extraordinary uncertainty about the depth and duration of this crisis. So, Andrew, based on those quotes there, do you think a projection of a recovery in 2021 is too optimistic?
Well, I think that policymakers and all of us in business and the public as well need to expect the potential for a wide range of outcomes. I mean, if we plan on only -3 growth and ends up being worse, that's not a good outcome. The reality is that no one knows how this is going to unfold. I mean, there are many, many scenarios out there. There's new news every day on the scientific front, on the health front. There's different modeling that has peaking at different times. And of course, what we also don't know, and once we are over the worst lockdown conditions, how consumers will behave. On the one hand, we've got the destruction of the individual and corporate balance sheet, so they're not spend. On the other hand, there are also possibly be changes in behavior. Are people going to rush out to travel when the lockdown is released? So we have so many unknowns, and I think that policymakers need to prepare for a wide range of scenarios. Now, I think, though, the good news is policymakers have recognized the scale of this around the world, in Nigeria, across Africa, the kind of responses. The problem is that in Africa, we don't have the resources to have the same magnitude of policy response. If you look at the UK, 300 billion pounds, almost 20% of the GDP that we're prepared to put for small business guarantees. Germany, a quarter, 25% of the economy. So we've had fiscal stimulus across Africa, South Africa, Kenya, Nigeria. We unfortunately don't have the same level of resources.
Thank you so much, Andrew. Andrew, we kind of need you to either turn up the volume on your mic or reboot your internet, because I'm having a little trouble hearing you. But I did catch what you said. But if you could just, I'm going to go over to Sanyade Okoli in a second. If you could raise it up there.
Spoken.
Cool. Thank you so much. All right, Sanyade, let me come to you now. The South Africa, the Business for South Africa Alliance, which is a group that was formed not too long ago, about 4 weeks ago, they've projected an economic contraction of 8%, which is not quite double what the IMF has projected at 5.8, but it's much worse. Is that, when you consider all the issues you and I have discussed on the show, what South Africa has been facing, is that a contraction of 10%? Is that more realistic for what South Africa should be looking at later this year?
It's difficult to say, but I think it's interesting that it's actually the local business people that have been more bearish in their forecast than the IMF, and obviously they're closer to seeing the real effects of the lockdown on the economy. But as with everything associated with this pandemic, it's just so uncertain. Nobody can say categorically how it's going to all end up. The way I look at it, it's almost as if somebody has thrown a whole pack of cards up in the air. And until those the cards land, we really don't know exactly how everything's going to play out.
Thank you for that analogy. Thank you, Sanyade. All right, Lukman, I'm going to come to you now. We've just talked equities. Let's now look at fixed income, Lukman. How have you seen investors treating fixed income? Have they treated it like a safe haven because equities are volatile? How are you seeing things with how the pandemic has affected the fixed income market?
Well, earlier in March, and mid-March, there was a major disconnect as investors actually adopted a sell-for-all mentality. We saw equity, safe havens, and even bonds being sold off as investors were looking for the most liquid asset, which was, interestingly, the dollar. It was only mid-March when the Federal Reserve came to the rescue by, cutting interest rates and launching a massive bond buying program. We saw some semblance of normality back in the US bond markets and across the globe. Like today, we saw Treasury yields falling because there's appetite in bonds. So I think as uncertainty continues to increase, especially after the IMF's really gloomy growth forecast that economic world growth could actually be its worst in almost a century, I see bond markets pushing higher in this period of uncertainty.
All right, thank you for that, Lukman. Chika, I'll come to you. Follow up on the last question. So you mentioned the previous recession, 2016. It took us until the second quarter of 2017 to emerge. Right. I want to ask you, based on IMF is also projecting that Nigeria will emerge from this in 2021. So using our last experience, are you in line with that, or do you think this could be projected to where, it may not be until 2022 that we emerge from this?
If you follow from what Sanyade just spoke about, there's like a pack of cards thrown up in the sky, and we don't know where the cars are going to fall. So everything depends on one, how long will this, pandemic, last? Nobody knows how long it will last. So a lot of the predictions are based on the fact that, max three months horizon, everything that's from this pandemic will clear out, and the economy will start rolling again. That's basically what it's saying. And we do recall also that Nigerian economy is, as we say in this program, that when oil prices, sneeze, Nigeria catches cold.
Yes.
A lot depends again on the recovery of the oil market. Despite the agreement reached in the OPEC Plus meeting, the prices are still struggling. We believe that for the Nigerian economy to recover, the oil price must inch above the $40 level, and that has not happened yet. So if you put all in a basket, we love the prediction of the IMF that 2021, I guess we're going to have a growth of about 5%, which will lead us to recovery. But it depends on a medley of so many factors, including the price of oil and how long this pandemic lasts.
Thank you so much, Chika. All right, Andrew, hopefully we can hear you much clearer this time. I'm going to come back to you, Andrew. You said, I was reading one of your tweets, and you said that African nations on the path to recovery have to do what they can to attract FDI, foreign direct investment, not FPI, foreign portfolio investment. But you also said that during times of crisis, that frontier markets developed economies tend to pull their money out of emerging markets. So what's the challenge going to be like for, emerging economies to be able to attract FDI at, a crisis period like this?
Well, I mean, to begin with, in terms of pulling money out, I hope you can hear me better.
Yes, we can.
Look what's going on. I mean, people are to the dollar. The world has a dollar shortage. I mean, the devaluation we've seen in the naira is not only us. The Turkish lira, the Brazilian real, Indian rupee are all in the same situation. There's not much we can do about that. In terms of foreign direct investment, I mean, the truth is that right now the foreign direct investment is zero. Because to make foreign direct investment means you have to show up in the country, you have to explore opportunities, you have to sign contracts, you have to make commitments, and none of that is happening during the lockdown. So the question is, as we come out of this, how do we create the conditions in which foreign direct investment is going to want to come back? Again, we go to something we've talked about for years in the country, which is ease of doing business. PEMEC, Dr. Jamoke, who've tried very hard. We need to make more progress on that. And one of the things that we've been saying is, look, beyond the crisis, if we're going to come out of this, we need to make some structural decisions to help the country. Now, of course, interestingly, at least two of those decisions have already been made by circumstances. So the fuel subsidy has been essentially eliminated, as many people have talked about for years. And in addition, there's been a readjustment of the exchange rate and a narrowing between the parallel rate and the official rate. So that's good progress, but it just needs to be an easier environment to do business. Otherwise, as we come out of this lockdown, people are still going to avoid Nigeria as a place to invest. But it's urgent that we get investment, both from Nigerians and from people outside, as we come out of this. So unless we make the ease of doing business better, we're just not going to come out of this recession properly. Last comment I'll make on this, in terms of oil price, we were roughly demand-supply balance at the end of 2019. 25 to 35 million barrels a day have come out of the demand. OPEC has agreed to cut 10 million barrels a day. So even if they succeed, we're still storing oil at about 20 million barrels a day. The U.S. is about to run out of storage in the next month. Very difficult to rely on an oil price recovery to get us out of this situation.
Thank you so much. Thank you for that, Andrew. Sanyade, I'm going to come back to you now in South Africa. Just yesterday, Central Bank of South Africa cut their benchmark interest rate by a full percentage point. I believe this is their second cut this month and their third cut this year. But considering the way things are rate cuts, is the effectiveness of rate cuts, are they falling? Are they still effective? How do you see things, considering how unique this problem is, this virus we're facing?
Well, the reality is we haven't been this way before. So, at times such as this, people are going to use the tools that they're used to using. And they will use that first, whatever they have in their arsenal first. And then over time, depending on how they see that playing out, They will then look for other tools to achieve what they need to achieve. But the reality is you do need a rate. They're not the only ones. As you know, across the world, central banks have been reducing their interest rate, because the last thing you need at this time is some kind of credit crunch. They really need to give some kind of, essentially give businesses, give borrowers some kind of break, because there's so much else that everybody is dealing with. So you can't fault them for that decision. But to your question, how effective is it going to be? Time will tell.
Thank you so much, Sanyade. Lukman, let me call over to you now. Commodities. You just heard Andrew talking about oil prices and what the huge supply global. I want to ask you about gold. Let's start with gold first. Last time you and I spoke, again, about 60 days ago, I think gold was touching about $1,500 levels. Since then, it's moved, I think, upwards. Have you seen the movement of gold with regards to whether or not investors are treating it as a safe haven, considering how things are with the coronavirus?
Yeah, I think gold has been the star of the show. It's glittered through the market chaos. I remember last time we spoke, it was around 1,500. Now it's appreciated over $200, and it's roughly 13% year to date. So this is the really correct environment for gold. We have lower interest rates across the globe. Over 60 plus central banks have lowered interest rates in an effort to defend their economies from the negative impacts of the coronavirus. And this is good for gold, which is a zero-yielding asset. At the same time, there's fears over a global recession and general uncertainty, which has really supported the flight to safety and made gold the hotspot for safety. The only concern with gold's outlook is the dollar, because I think there's a tough tug of war going here, because the dollar is also a destination of safety, so is gold. So where gold trades in the end of Q2 and probably 2020 will not only be influenced by the global outlook, but the dollar's valuation.
Great. Lukman, I'll stick with you for one quick follow-up. You just heard Andrew's comments on oil. Do you share in those, or what's your outlook for oil prices, seen as Nigeria and a number of countries depend on it?
Yeah, I agree with Andrew. I believe oil has been one of the biggest casualties of the coronavirus outbreak. In the first quarter of 2020, actually depreciated over 65%. Now, this is really, really painful, especially for many emerging market energy producers. There's three things that are really hitting oil. The first thing is OPEC took too long to make a move. They took the wrong decision by actually going ahead with an aggressive price war, and they disappointed markets by actually slashing production by 9.7 million barrels a day, because I think markets were hoping for something around 20 million barrels a day, especially when we consider the 20 to 30 million barrels a day demand destruction created from the coronavirus outbreak. As things stand right now, we know that demand remains a major tool in the equation, and for as long as demand is missing, no matter what OPEC does, oil weakness should remain a major theme. And I think $40 could be a lid in Q2 unless the global macroeconomic conditions change, meaning if we see a cure for the virus, or the visible rate of infections, or death rate drops.
Thank you for that, Lukman. Thank you so much. All right, Chika, I'll come to you now. You've been on the show several times. We've looked at banking sector results in Nigeria. I want to ask you, based on where the contraction, how we see things going for the financial sector, which is the most active sector in Nigeria. How do you see things for banks in 2020, compared to what we saw in 2019? Even
before the comments of the COVID-19, a couple of the CEOs I spoke to told me that 2020 is going to be a bloody year for them. There's a lot of regulatory pressures on them. Margins are dwindling, and especially on the first-line asset products that they've historically been pushing. Fees and commission lines, as you know, new rates were pushed out by central bank effective January 1, 2020, and so on all parameters, the revenue lines were going to shrink. Now, with the coming of this COVID-19 now, you're going to have issues of reduced volumes, which will lead to reduced profitability, loan performance pressures. So you don't be surprised on the increase in NPLs, and of course, a lot of pressure on capital adequacy arising from loans that have gone bad and reduced profitability. So it's going to be a very tough year for the banks, and the kind of big results we've seen in the past year especially, we don't think that they're going to happen this year. The Q1 results are going to come out shortly for most of the banks. The impact would not be so much. The impact of COVID-19 on it will be so much So that will not, tell us so much what's going to happen during the year. But I do believe that this is going to be a tough year for the banks.
Thank you for that, Chika. Andrew, we're going to come back to you now. Just yesterday, March retail sales numbers in the United States were released, and I believe we saw a record drop of about 8% or so. Can you speak to retail sales figures in the United States as a bellwether for the troubles that the COVID-19 has caused for the U.S. economy?
Well, I think it exceeded what analysts expected. Remember that most of the country during March was not under lockdown. Really, the more than half of the country became under lockdown in April. So the fact that without lockdown complete, you still had minus 8% in retail sales. Remember what's happening here, right? So there's no spending on hotels. There's no spending on airlines. There's no spending on restaurants. People are not in the mood. Amazon's not delivering non-essential goods. People are not in the mood to go out and buy things in the present circumstances. They've had the unemployment number, so we're going to get the release very soon of this week's unemployment. We've had 17 million jobs lost in the last 3 weeks, or people who've applied for unemployment. So, I thought 8% was a relatively good number, but and this is, of course, why you get all of these discussions in the U.S. about opening up the economy, that day by day the pain increases. And again, it just shows one person's spending is another person's income. But until people can go out and spend, well, first earn money, they need to earn money, because as I said, there's a destruction of the personal balance sheet in all this. So even as the lockdown is relaxed, are people going to be willing to go out from a medical viewpoint in terms of their normal activities? Are they going to be able to go out in terms of an economic activity they're normal? So I think a lot of commentators have started to say, look past the massive lockdown and say, actually, things are only going to come back slowly.
Thank you for that, Andrew. All right, so, Sanyade, I'm going to come to you now. We've discussed on this show, we've talked a lot about South Africa's airline, the state-owned airline, the struggles that have been going on between the airline and unions, and whether it's too big to fail. Also, just yesterday, news broke that the South African government had finally cut funding for the airline. What's your take on this move with regard, and what does it say about conditions there now?
Well, it's not at all surprisingly. As you said, we've been talking about this for months. To a certain extent, it has seemed like almost a bottomless pit for government funding. And, at times such as this, they really have to ensure that they're prioritizing their spend. But unfortunately for South African Airlines, it's coming at a time when the aviation sector globally is particularly challenged. So it's, the big question is, well, what does this mean for the company? It was already in some form of local administration. So, where to next? And, before in the past, we've spoken about whether or not it should be privatized and how attractive it will be. Unfortunately, with the current timing, if they seek to do that now, it'll be an even tougher sell.
Thank you for that, Sanyade. Okay, Lukman, I'm going to come to you now on currencies. Lukman, how have you been seeing things with regards to the dollar's performance in the wake of what COVID-19 has, the effect it's had on the economies? How have you seen the performance of currencies like the dollar and on others in other currency baskets?
The dollar was actually king of the currency markets in the first quarter of this year. It's appreciated practically against almost every single G10 currency, excluding the Japanese yen and Swiss franc. I think the dollar is still going to remain in fashion in the second quarter of 2020 for a couple of reasons. Number one, it's still seen as a safe haven destination, despite those abysmal US retail sales figures from the United States. I think there's this sentiment that no matter how bad things are in the largest economy in the world, it's probably going to be worse elsewhere. That's why investors are still rushing towards the dollar, which is also a reserve currency. Another thing is that if we have another possibility of another credit crunch or liquidity crunch where, the uncertainty is so bad, investors start to offload all their assets in a dash for cash, this could also support the dollar in the second quarter of 2020. My only take is, one key thing is how badly would the United States economy have to be for investors to start to question the dollar status as a safe haven destination. For example, if the US jobs report continues to disappoint and retail sales is even more abysmal, even more worse in the coming quarters, the dollar status could be at threat with investors looking towards the Japanese yen and the Swiss franc.
All right, thank you for that, Lukman. Chika, I'll come to you.
Okay.
We've heard Andrew talk about the U.S. job numbers. We just heard Lukman talk about U.S. job numbers. I want to ask you, you and I, we've talked about this on the show. We're yet to see an update from Nigeria on unemployment since Q3 2018. Do you think with what COVID-19 is doing to Nigeria's economy, do you think that perhaps, possibly the government can be forced into trying to get the data to have a handle of how many job losses we could have this year or who is being added to the unemployment lines?
The excuse that the MBS, the Bureau of Statistics, gave was they didn't have the funding to be able to push out the results subsequent to Q3 2018. And, for an important statistics for the economy, we were surprised that that has not been done. And they say that, unlike other reports they push out, this one requires, a nationwide, survey to be able to do that, and it costs them a lot of money. I would have thought that the government would have provided the funding required to push out this kind of important statistics. But be that as it may, it don't require rocket science to know that the figure of 23% that we had in Q3 2018, the last time it was done, would have ballooned, to high heavens subsequent to that. You just need to look around and know, as the economy has come to a standstill, of what's happening. Sadly, for us in this climb, unlike other places where some kind of stimulus or support have been given to the SMEs, the core segment of the economy, nothing like that has been done really directly for this kind of businesses here, and they employ the largest part of the population. So we're hoping that because it's not a good political result for the government that the employment is going off. So I don't think they're encouraged to provide the funding required to get this out. But we hope that for planning purposes, that this is done rightly and that we have the right employment figures out, at least the current ones.
Thank you for that, Chika. Andrew, let me come back to you now. It's understood, I'm going to talk lockdowns. I'm actually going to share this question around our panels, but starting with you, Andrew, on Canada, it's understood that the lockdown there is supposed to be extended until June, I believe. What kind of impact do you think that's going to have on the Canadian economy, which is also projected to contract as well by the IMF this year?
I think Canada's going to have the same impact as other developed nations. I haven't seen any official numbers. I can imagine shrinkage of the economy of -5 to 10%. But if you look at the number of deaths in this country, in Canada, we've done relatively well compared to others. It's about a quarter of the U.S. We locked down earlier. There's been a high degree of social cooperation with the lockdown. There's been significant fiscal stimulus like some other nations. And it's not just the announcement of the fiscal stimulus, it's also getting money in the hands of people, of small businesses. And I think that's been relatively successful in the country. So there's no unrest, there's no pushback to open early. The Prime Minister, of course, Prime Minister Trudeau, his wife had coronavirus. So Canadians were very aware of how serious this was very, very early. So God willing, we'll hopefully come out in relatively good shape in Canada. But yes, the economic destruction, as I said, if we have lockdown in these conditions until June, we're going to have, as I said, -5 to -10% GDP contraction.
Thank you for that, Andrew. All right, Sanyade, let me come back to you now for South Africa. President Ramaphosa was asking CEOs and business leaders to take pay cuts, and they obliged, and they're donating a portion of their salaries to COVID-19 efforts as far as to fight against it. What's your take on the move? Is it symbolic, or is it actually something that actually should have an impact on what's going on there?
Well, it's real, because some of the numbers you've heard of CEOs and more relevantly HNIs donating, I can't remember who, but somebody has donated R1 billion. So that's a significant amount of money. And they want that put towards, supporting SME businesses, because obviously they are particularly challenged at this time. So it's definitely a good move. It's a shame. I think a few people are trying to politicize it a little, saying that it suggests that the government is a little, or business is a little too close to government. But at this time, it really has to be everybody coming together to move things forward. It's no time to be politicizing anything.
Thank you for that, Sanyade. All right, Lukman, let me come back to you. I want to follow up on what we just talked about with currencies. We're talking about the dollar as a safe haven. The yen and the Swiss franc, I mean, I believe, help correct me if I'm wrong, they've also been considered safe havens as well. Are you seeing any movement there with the yen and the Swiss franc? And are there any other currencies we're not looking at outside of the dollar, yen, and Swiss franc as far as safe havens for investors with the effect of COVID-19 on the macroeconomy?
Yeah, as far as safe haven currencies, it's still the power three: the dollar, the Japanese yen, and the Swiss franc. You know, all three of them have performed well against G10 currencies, Asian and emerging market currencies. If we try to look at any other currencies, for example, the euro is very vulnerable right now. You know, we've got Italy facing the possibility of a sovereign debt crisis and the European economy sinking into a recession. If you look at the British pound as well, the pound has weakened to levels not seen since 1985 due to fears around UK growth actually experiencing a recession not seen in 300 years, shrinking by 13%. And this is the same sentiment we're seeing across other G10 currencies and emerging market currencies. So in such uncertain periods, I think it's the power three: the dollar, Swiss franc, and Japanese yen will remain the eyes of the start of the show in Q2.
All right, thank you so much, Lukman. Chika, I'll come back to you. I just asked you about, I'm giving you all the tough questions for Nigeria. I'm sorry, but I just asked you about unemployment, yes? Now I want to come to debt. You know, I want to ask you if you're worried about the size of Nigeria's debt, and also you've had the stimulus that the Ministry of Finance announced, and then how we now have to go borrow even more at this tight period with the size of our deficit. Are you worried about it the size of the debt, it growing and then possibly ending up, I don't know, like Greece or something? Well, what's your take on our debt?
We have always said in this program that it's not wrong to borrow, and but the problem is what do we do with the debt? And that's Nigeria has lacked the discipline over the years to use debt, efficiently, and that has been the problem. And so, how do we get out from this? We have a fiscal deficit, projected of about $9 billion. Oil prices are, are cratering and then falling, down there in the pit. So what do we do? And to fill the gap, we need to borrow, and that's what is the reason to about $6.9 billion of additional debt. That will, if you succeed in that, it brings our debt to about 30 trillion naira. Our GDP, debt to GDP ratio is still low comparatively to our peers, but the issue has always been our debt service to revenue ratio, that we are using a significant part of our revenues to service debt, and therefore emasculating other important segments of the economy. A situation where more than 2 trillion naira is budgeted for debt service during this year, almost is equivalent to the amount in capital expenditure. That's where the problem is. And if that happens again, we're going to get into more problems.
All right, thank you so much, Chika. Okay, I wish we could continue this. We only got like a minute left. Very, very quickly, Andrew, if you could please give us your final thoughts in about, 10, 20 seconds for what's going to happen as far as the economy is concerned.
I think that right now the focus should be on making sure that we get resources to the bottom of the pyramid and we keep the food supply moving. Because if we have social unrest and people not able to eat, the economy is not going to matter anymore.
Thank you, Andrew. Sanyade, please, if you could, in a few seconds.
Yes, as I said, we haven't been this way before. So bottom line is we all have to be solution-oriented, but making sure that we're developing solutions suited to our own environment.
Thank you, Sanyade. Lukman, your final thoughts in a few seconds.
Yep, central banks and governments have done all they can to try to promote some stability, but especially considering the coronavirus as a health crisis, I think the answer to this problem is a cure to the virus.
All right, and Chika, your own thoughts too.
Like our CBN governor asked, what if this is a new normal? So we must try to see the good in this and profit from it for the good of our country.
Thank you so much to our panel. Andrew Nevin, Chief Economist at PwC, Sanyade Okoli, CEO of Alpha African Advisory, Lukman Otunuga of FXTM Trading, and Chika Mbonu, our business analyst. Thank you all so much.